I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a guy we had on who has his own website, been on since the early 2000s, one of the forerunners of real financial, journalism and financial counterculture on the Internet. I had him on about a few months ago, and he said that interest rates would go down. And we had maybe a little blip, but interest rates have definitely gone down. Now they're talking about negative interest rates. I'm talking about Rick Ackerman from Ackerman-Nothing, and also his famous articles that he calls Rick's Picks. Rick Ackerman, thank you for joining us today on USAWatchdog.com.
Thanks for having me on, Greg.
Well, big call. It looked like the interest rates were going to climb a little bit, and then all of a sudden, boom, 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 they came right back down. Was that baked into the cake? Did that give you a little bit of a heart attack? What do you think about what interest rates now?
Well, if you look at the long-term bond charts, you see that everything that's happened since last spring has really been corrective, and it's against a very powerful rally. So, in perspective, we've just been kind of noodling around for what I think will be a big second leg up on the bonds. Currently, futures trading around, where are they here? 157.23. I think easily up into the 170s. And I just put out a forecast, not on the bonds themselves, but on interest rates. My original long-term forecast was 1.94% on the 30-year. I'm now looking for 1.64%.
So interest rates going down, what does the world look like at 1.64%? I mean, everybody thinks, oh, wow, things will be going great. Everything will be rolling. But that's not what you're really forecasting. You're saying that when interest rates get that low on 30-year money, danger, bad things are happening in the economy.
Yeah, it's a question of being careful what you wish for. And, there's already talk that we need to keep mortgages below 4% or 3.5%, and you would think that if long-term rates come down to 1.64, that we have another refi mania. But I don't think that can happen because, as you know, they've tightened the rules for borrowers, and that 20% down payment is going to extract a lot of money out of savings, so that even though lower mortgage rates would give us additional cash flow, for households down the road, the initial impact is one of people reaching into savings to get that 20% down payment. So it's very deflationary initially, and I don't think the economy, the recovery such as it is, will stand up to that.
Do you think that the Federal Reserve is not going to raise rates in December? Other people have said, no, mi princess, the economy's not going to be fixed in December. And do you think they're going to be raising rates, and why do they keep chanting this? Oh, we're going to raise rates in 3 months. Oh, we're going to raise rates in 6 months. Why? What's up with this?
I think that the Fed is really doing the only thing that it can do at this point, which is nothing. They can sort of talk the talk, and that's what they're doing. They can't really sort of go to the dark side as far as they're concerned and talk about easing, but that's really what we're going to get. I've never been a believer in the recovery itself. We've had a fabulous recovery on Wall Street, but anybody out there in the real world can kind of look around and see that a lot of businesses, especially brick and mortar retail, are struggling for their lives here. So, I haven't merely said that the Fed wouldn't raise rates. I've been shouting it from the rooftops that the answer to the question, when will the Fed raise rates, is never, and I still stick by that. That forecast has held up for 9 years now, so it's looking pretty good.
Oh, you made it 9 years ago that they would not be raising rates. The other thing is our federal deficit would blow up too.
Yeah, that's a big problem. You subject not just the U.S. federal deficit to just a turn of the screw with a few extra basis points. And, it's a global thing. We'd essentially be ratcheting up the interest payments on a quadrillion-dollar derivatives market. And as you can imagine, that would unsettle a lot of arrangements.
David Stockman, former White House budget director, he says they have to raise rates. They just have to raise rates. And you say they won't raise rates. He also says if they have QE, it will work. It will not work. What do you say about those 2 points? Do they have to raise rates anyway, even though you say they won't? Do they have to raise rates for some reason, for credibility or to protect the dollar or whatever? Or and if they have helicopter money and they start doing QE4, is that going to help? Is that going to cause inflation?
Well, David Stockman republished a piece of mine, I guess you could call it a deflationist perspective, on his own website, and he said, in so many words, I agree with everything Ackerman says except for the interest rate part of it. But I'm going to stick with lower rates, and it's partly because the whole world is slipping into recession. China at the margin is your big guy there, and the economy has slowed considerably. But we just don't have the Fed's plan all along was to get the economy to grow us out of debt. But it hasn't happened. You know, they've still got huge amounts of bogus bad paper that they're warehousing, and you can't really raise rates when you're teetering on the brink of a global recession. So I don't think it's going to happen. And I think over time, a lot of money, certainly sovereign buyers, have stepped away from U.S. long-term treasuries, 10 years, 10-year notes and 30 years, namely Russia, Brazil, China. But at the same time, you've had a tripling in the purchasing of long-term U.S. debt by private entities, companies, banks. So I think it's, on balance, it's a push right now. And although the sovereign buyers they're not going to get any worse in terms of disgorging their holdings. That trend has already played out. But you're going to see the private end of it pick up, and that will be supportive of bond prices and therefore of lower rates.
Could this thing just blow up and cause that big black hole? You said that the bonds are going to cause a black hole. It's so huge there can't be any inflation. That's your premise, that the debt is so huge that when it goes, it just goes. They can't print enough money to try to prop it up. Is that your basic premise?
Well, the big enchilada is the dollar, and I've been saying since the 1980s that when we came to some sort of end game, that the dollar would be right at the middle of it, mainly because the market for dollars is hugely larger than any other market, even much larger than the bond market, which itself is much larger than the stock market. So the amount of money, leveraged dollars in play in the derivatives market, you can very conservatively estimate it at maybe $250 trillion, a quarter of a quadrillion dollars. But if you take a darker view, the number is closer to $1 quadrillion. So that represents to me potential deflation, because it's this giant market of dollar-denominated instruments for which there is little or no collateral. So we've been kind of fighting to keep that juggernaut from deflating. But as much as the central banks want to say they're in charge, they're not in charge of the dollar market. It's vastly larger than all of the central banks put together.
Do you think that these bonds, they're collateral, correct? All these bonds, people use them as collateral, right?
Yes, and you have to wonder what backs the bonds themselves.
Well, if the collateral gets destroyed, aren't people going to be looking for new forms of collateral, physical, tangible assets, land, diamonds, gold, silver, factories? If the bonds are destroyed, what are they going to do for collateral?
Well, in the hierarchy of assets, you can't beat farmland. And even though I think there are good reasons to be very bullish on gold, I'm always I raise the rhetorical question to my own subscribers. Do you think that if gold goes to whatever some of these outlandish prices are, $5,000 or $10,000 an ounce, or I've even heard $50,000, do you think you will be nimble enough and wily enough to trade a handful of Krugerrands to some farmer for farmland? So even if gold were to really take off, you'd need to use it in barter for something that most...
you need to buy some stuff.
Yeah, you need to buy some real stuff.
Well, gold's real stuff. I mean, gold is real stuff. No counterparty risk. I've always heard gold does well in the extremes, inflation and deflation. And we've had extreme inflation in the past, and some people are forecasting that. And you're forecasting extreme deflation. Would gold be useful in extreme deflation, where you found out that your bank account got sucked up and lost, and the FDIC couldn't pay people off? Would that be worthwhile then?
Well, the one thing that I can guarantee you about gold, and I guess this makes me a bull somewhat, although I'd say a cautious bull, is that that gold will absolutely hold its purchasing power no matter what extreme crisis happens. It may be that gold's only $850 an ounce, but you can bet that will buy that nice dressy man's suit at that point. So I have no doubt at all that in any crisis, whether it's hyperinflationary or deflationary, that gold will at the very least hold its purchasing power.
Do you ever worry about the brokerages going under? I mean, you're a trader. You give your Rick's picks, excellent writing, excellent trades for your subscribers and things like that, and you walk them through it and give hidden pivot points. I believe that's what you call it. Do you ever worry about the brokerage you're using going under and saying, "Oops, we're MF Global"?
Yeah, everything is tied together, and you're not going to have the scenario that I pose to my readers and subscribers is that you wake up one morning and the banks, for whatever reason, they fail to open. And at that point, forget about lining up at the bank. There's only enough money at a typical branch to pay off one or two depositors. So you can imagine that if that situation existed, people are not getting their money out of banks, the entire system of plastic money would begin to fail. It's based on trust, I would say misplaced trust, but there are a lot of very delicate clearing relationships that make it possible for you to take a piece of plastic out of your wallet and you have a certain credit line and you can buy things. That won't happen. So the best you can do really to prepare for that day is to have a shoebox full of 5s, 10s, 20s, and 50s and 100s, because even though over time in a crisis, gold and silver will work their way into the money system, you're going to find Gresham's Law at work, where they want to hold on to the good stuff, to their gold and silver, and use whatever else is accepted as money. So even though I'm looking at the dollar, there's nothing behind it. In a real crisis, actual physical cash money would definitely have usefulness, because the Safeway clerk doesn't understand pre-1964 silver coins, junk coins. He's going to say that's a dime or that's a quarter. So that'll take a while to get sorted out.
Do you think that's what we're headed for? A huge, that's what David Stockman thinks we're headed for, a huge black hole of a deflationary crash where just people wake up and no retirement, no stock accounts. A lot of the banks go, a lot of the money goes, a lot of the bonds, the collateral. You think the whole thing goes poof? We start over. I absolutely do, and I think that David, in saying that, reveals a contradiction in his own idea that we're going to have interest rates off the charts. Essentially, more is owed in this world than can ever be repaid, and there are only two ways to get rid of that debt. One is a hyperinflation, and the other is deflation. In a hyperinflation, the creditors get stiff because you'll wind up with $250 billion in your wallet, and you can easily pay off your $200,000 or $300,000 mortgage. So in a hyperinflation, the creditors all get jerked. In a deflation, bankruptcy sort of determine the course of it. But I'll leave it to you to judge whether it's likely that all mortgage debtors are going to skip free. I just can't see that happening. I don't either.
I can't see a hyperinflation that would make all mortgage debt serviceable with the kind of cash you'd be carrying in your wallet.
Some people say, Jim Sinclair, one of them says, well, if they do have hyperinflation, they'll pass a law and they'll just reissue the mortgages in the new currency. They'll have a new currency and they'll reissue the mortgages in a new currency.
I think we can already see how it'll play out. The idea I've carried in my head for a long time was that all mortgage contracts would over time come to resemble tenant landlord agreements, that we would effectively be leasing our homes. And that's true in a de facto way now because, there's no market for first-time buyers. They're all kind of renting, so nobody's owning. And I think the trend toward less ownership will extend to people who actually are living in homes paying mortgages. So I think that's how mortgage debt will settle out. We're essentially going to be in lease arrangements with the mortgage creditors.
Do you think that people selling U.S. Treasury debt and bonds and things like that, you think they'll be sucked up in by these banks and these private hands or the Fed or whoever, and they won't come in and drive the stock market higher or drive inflation higher if they have to liquidate all this debt?
Well, usually when you mention the word they have their hands on all the assets, and they are trying to create some crisis that would essentially put the assets in the hands of they. But what we built up such an incredible juggernaut of potential disaster that I don't think they are really any smarter than we. That nobody can be sure that whatever he's holding in physical assets now or in financial assets is going to be worth anything after the fall. So it's going to be a free for all. And as we were discussing earlier, I think gold is certainly a good asset to hold, regardless of which way you see the crisis unfolding. But I see initially a deflation, and everything that's happened over the last 5 years for sure has pointed in that direction, especially the implosion of Europe. They can't inflate their way out of anything, nor can Japan. And the U.S. has been able to do that because funny money is more easily, let's use the word, actualized in the consumer sector. It's easy. Americans can very easily borrow and spend, but that's not true in Europe. They don't have our bad credit habits, so we've had a more effective easing here.
You said that your assets won't be worth anything by the end of the year. Do you think this thing will come apart by the end of the year?
Oh, no, I didn't mean to suggest
okay.
the calendar date there.
But Stockman thinks that it all unwinds sometime before the 2016 presidential election cycle happens. Do you think that's a good call, or are you queasy about making any kind of date calls?
I don't believe the election cycle is going to prevent a disaster from happening. It may happen before or after, but we're no longer at the point really where the Fed can, typically when they say the Fed will prop the economy and the stock market up to elections, it's because they've got something to work with. We'll already be at 2 or 3% borrowing rates the federal funds rate, for one, will not be close to zero, but they have no room to move right now. There's no room for stimulus. And the one thing that argues against stimulus will save us is that over time, the whole dynamic has changed. There was a time when stimulus, which is effectively borrowing, that it would get us out of the hole. And I just lost my thread there, but it took about 50 cents of borrowing to create $1 worth of real growth. And since that time, the best we experienced was post-war, sometime around, I think, 1951, 52. But now it's off the charts. We can't even count the number of dollars of borrowing it takes to create $1 worth of GDP growth at the margin. So we're really getting less bang for the buck stimulus-wise, and you can see that all around you. The Fed eased and eased and eased, and all we got was an asset inflation in the stock market.
And you don't think they'll do helicopter money, because that's the prevailing thing now. People are, helicopter money. What Ben Bernanke said, if he had to, he'd drop money from helicopters, is what he said early on in his career.
I'm not a helicopter money guy. In fact, helicopter money is good for creating the financial the inflation that we've seen in the stock market and in other financial assets. However, one of the big deflationary juggernauts is public pensions. And if you just sort of play that forward, how would we use funny money to bail out the public pension system? You find that there's no way. It's one thing to push the stock market up, but it's another to create the kind of money, and this would literally be helicopter money, just giving it to people to pay their monthly, to pay pension obligations, not just of the federal government, but of municipalities, to local governments. It's too much to bail out. And the political ramifications of the monetization of public pensions is that all of those of us who would still be paying taxes to fund that charade would riot in the streets. So public pensions to me is where the rubber hits the road. It's a very particular and specific instance of a place where you're going to have an implosion. People will either get their checks or not. If they do get their checks, we know it's not funny money; it's the real thing, and that's the kind of inflation the Fed cannot create.
So you think that's one of the big stumbling blocks, public pensions in the future?
Absolutely.
And so you don't. So the helicopter money would become in that realm, and you don't think that they can even attempt that. And so you think pensions are going to go way of the dodo bird. They're going to come up someday and say, "Hey, yeah, we promised that. Thanks for your votes, but we can't pay that." Is that what you say they're going to do?
Right. And the settlements so far, like in Detroit, for instance, the settlements were not quite as hard on labor, on the unions, as you might have expected. The only reason it was possible to bring about a solution in Detroit that didn't totally wipe out both sides, creditors and the unions, is that the rest of the country, in effect, is carrying Detroit. In a way, it resembles the Japan deflation. Japan, the one thing Japan had going for it when its deflation began in the early 90s is that the rest of the world was doing just fine. So Japan, even in deflation, still had a big market to export into. So that's why Japan's deflation was not catastrophic. But this time you might say, well, if the U.S. needs a buyer of last resort, if we need something to pump the economy, it doesn't exist really. We'd be in a pure deflation with no countervailing force. So there's really no way out.
Assets destroyed, bonds destroyed. That's the real true term for deflation, correct?
Well, the monetarists all talk about inflation being an increase in the money supply, deflation being a decrease. I think that's all garbage. Nobody even understands what money is, what is usable as money, how it comes about. I say that the best way to understand deflation is to look at its chief symptom, which is an increase in the real burden of debt. And if you can say one positive thing about the easing that followed the collapse of 2007 and 8, it is that it created a mortgage refi cycle down to 3%, which freed up a lot of household cash. It basically made households liquid. We can't do that again because the collateral has already been spent. So we did something then in the previous easing that we cannot possibly bring about the second time.
So at some point, we get a total wipeout, a total reset in your mind. And you say that the 2016 election ain't going to put that off.
No, it's bigger than elections, and it's only by luck and good fortune that some presidents claim to have been good for the economy, some bad. Clinton had the good fortune to be president when everything was on an upswing. Bush the W, not so. We're in a situation now where any day something could happen. I think that the black swan will be something as obvious as the stock market starting down for no apparent reason. That in itself would trigger the implosion. And I think the only thing that's propping the system now is that in the backs of minds of pretty much everyone, Wall Street and people who don't even pay attention to the markets, the idea is, how bad can things be if the stock market is trading within shooting distance of all-time highs? So I think the stock market has been the main buttress of this enormous hoax that's been going on with easing.
And you think something could happen any time between now and the election of 2016? In other words, forget about the election. You're thinking that the end game is going to be here in a blink of an eye at some point.
Literally overnight. I don't think even the investors who think, well, I'm smart and I'm nimble and I'll be out of this at the first sign of trouble. I think the first sign of trouble will be a little bit too late. You'll wake up one morning and something will have happened in Asian markets that cause the U.S. markets to open way below their circuit breakers, or at least to threaten to break the dam. So I don't. It could all happen literally overnight, and I think it will. It's in the nature of the markets that even those who have been kind of ready for 5 or 6 years for the downturn won't be able to benefit from it.
And you think banks are going to be not open? Brokerages, a lot of them are going to be wiped out. Pensions are going to go poof. Are these all the things that you think? What does it look like the day after it happens? What does it look like? What do the banks look like? What do the pensions look like? What does the government look like? What does the dollar look like? What does it all look like the day after it happens?
It's all of a piece. I don't think there will be anything left standing in the smoldering ruin.
Nothing. The dollar, brokerages, banks, pensions, all gone.
It's very hard to imagine, but it's really a complete disaster is commensurate with the scale and scope of the lies that we've been telling ourselves for so long. You know, there are people who say, oh, you know, you chicken little doomsday sky is falling guys. You almost seem to want the system to implode. But it's true, at least for myself, that I think the only way we'll get back to honest business is for a collapse to wipe away all the lies.
Oh, that's a great one. Collapse, wipe away all lies. I just want to talk one last thing. War, is that one of your black swans? I mean, what's going on? I know you're not an expert in geopolitical and war, but you're a trader, and you must take that into account. What do you think's going? What do you think about the saber rattling in the South China Sea and what's going on with Russia, Syria, Hezbollah, Iran, the U.S. in the Middle East?
Well, I think Russia and Putin really have to be considered they're the locus of whatever trouble could develop. And, you know, there's such a range of things that you could believe about Putin. He himself said in an interview with Charlie Rose that he's not really trying to expand Russian hegemony or create a beachhead in Syria to give Russia more muscle in the Middle East. He's really just kind of taking care of business. Syria has always been a client state, and he's just essentially trying to wipe out the opposition to Assad. So there are a lot of ways to read it. I hesitate to say that Putin is the one thing I'm optimistic about, but there's obviously always a threat of war. Right now we have a possible intifada building in Israel and the West Bank and Gaza, and you never know who that's going to draw in, really. So, yeah, I think there's an inordinate risk of any one of these conflicts spilling over. And as in the case of World War I, you're looking at all the big things, and you miss the significance of the assassination of the Archduke. There were so many things you could pick from in 1914 as to what might set off the powder keg. And it's the same thing now, but it's somewhat predictable that what finally does it will be not the thing that we're all looking at.
Rick Ackerman, listen, Rick, you come on and you answer comments for people. That's great. I hope you do that this time. Please answer a few questions. I know you have a subscription service. I'll put it for you guys watching this on YouTube. Just go to the link. It says all links are found on USA Watchdog. Click through, scroll down. You'll find Rick Ackerman's website, rickackerman.com, also his subscription service. Rick Ackerman, thank you so much for joining us today on USAWatchdog.com. That was a great tutorial, my friend.
Thanks much for inviting me on, Greg.